Hi folks, Jay Blanchard with the Financial Guys, Wealth to Women, and registered investment advisor with Independent Solutions. Wanted to get an update out to all of you. I've got a few litmus tests in my business, and what I found is if I get 3 phone calls, that kind of tells me that folks might be getting a little bit nervous. So over the last 2 weeks, I have received 3 phone calls from clients. So I want to get out ahead of the aircraft here, if you will, and be proactive and get some information out on the markets. I'm going to cover 3 things real quick today. What is causing the market volatility and the recent reduction? Number 2, what we're doing, and number 3, what you can do. So first, I want to quantify the volatility issue, and not to minimize things. But if you look out over a year, this is the Dow Jones. This volatility is within the envelopes that we've seen before. There's the S&P 500 right there, same thing. So don't get too nervous. Now, what is causing this? And I'm going to send you this article in the email. There was a really good article in Wall Street Journal earlier this week, and it talks about what happens with markets when there's a bad January. So this is S&P performance in January since 2000. Bold red is this year. Here's all these other years in here. And then it just graphs things out. And again, I'm going to go fast here because I'm going to send this to you. These are declines of more than 5%, going way back, 39, 60, etc. It includes '08. If you look here at the end of the year, most of the years we end up positive. So I wanted to give you some factual information, hopefully to fight some of the fear if you're having it. So I'm not predicting, I'm not guaranteeing in any way what's going to happen this year, but that's historically we end up positive at the end of the year. Now, what's causing this volatility? Number 1 is interest rates. Interest rates are going up, and basically every time a rate increase comes in, you're probably going to see a market pop to the downside, and it may take a while for the market to recover. Possible international conflict. I think this is probably a little more scary for the market and all of us, if you will, than interest rates. Very, very possibly Russia could go marching into Ukraine, and we might even see a Chinese conflict over Taiwan. So obviously those will not be good for the market. And then thirdly, COVID continues to linger, and we have no idea if another variant is going to come out, which really brings me to my 4th point, which is an inclusive point. These 3 things, what's the scariest for the stock market is the unknown. The stock market hates unknowns. It prefers knowns, even if they're negative, because of course corporations can deal with a known negative, but it's very hard to deal with an unknown or unpredictability, and that's why I think the volatility is so very high. Last chart that I'm going to show you today, this basically goes back to, I believe, 1925 and out to 2018. Don't get too distracted by the details, but different presidents, wars, recessions, depressions, the stock market overall has averaged about 10% since they started tracking it. Could this year be a bad year? It could. Do I think that we're going to have a positive year? I think we will, but there's some very, very valid concerns out there, and we have to see how these concerns are going to roll out. All right. So that's what's causing it. What are we doing? So we're staying proactive. The one thing we're not doing, we're not market timers, so we're not going to time the top, time the bottom. None of that is really in our philosophy. However, for those of you that have been in on reviews, we have, through a disciplined process of rebalancing, been very good at rebalancing. And we're not trying to do this. It's the discipline is creating the luck, if you will, of rebalancing when markets appreciate or decline. And that really helps you, sell high, buy low. And we've had pretty good performance throughout the COVID issue because of that. Very, very disciplined. Our bond portfolios. Just a little lesson in economics with interest rates. When interest rates rise, the longer duration bonds get hit the hardest. So, we started this quite some time ago. We have become ultra tight on bond durations. This is to help your bond portfolios in a rising interest rate environment. In stock portfolios, we've got a wide variation of stock portfolios, but just some generic things that we do. Dividend producers, large companies, even if the stock market drops, they're going to produce dividends. And you have this in your mutual fund portfolios too, if you have maybe a little less sophisticated portfolio with me. Those dividends, get paid out no matter what the stock price does. This helps with overall return. And, a plus to a drop in the market is earnings actually increase because stock price decreases. And if dividends remain the same or go up, you'll get an earnings increase. Some portfolios, we just let those dividends go to cash. Most of the time, we try and reinvest that. So that's how we do that. If there is, and I'm not predicting it, and I don't feel like we're going to see a huge drop in the market. Again, I've got my concerns, but if we did have a large correction, we would look at using cash possibly to buy stocks that are undervalued. Each of our different portfolio managers would address that in his own specific way. But, I know some of our portfolios are actually building up a little cash right now, just in case that happens. All right, so those are the things that we are doing. What can you do? Number one, don't panic. I think that you've seen with every illustration that I presented today that panic really has no role in a strategic plan. Don't take large amounts out of funds that have dropped appreciably in price. Again, depending on the size of assets that you have with us and with me, I may have broken your portfolios up by risk bucket. So what we wouldn't want to do, if we could possibly avoid it, is take a large amount of money out of your aggressive bucket, which is down. Where would we take it? Out of a conservative bucket that maybe is down just a little bit, right? So in dropping markets, or when you're taking income, try and avoid those asset classes that are underperforming right now, right? Next point. Don't watch too much news. I know that sounds kind of like broker speak, but quite frankly, I don't. I learned in 07, 08, and 09 that leaving my TV on all day left me very depressed. And so, if you come in my office, you see that my TV is on, but the audio is off. If a interesting interview comes up, I'll turn the audio on. Otherwise, I leave it off. I'm not telling you to be oblivious to what's going on, obviously. And the other thing I won't tell you is don't look at your statements. I want you to be aware. But I think if you get too involved in the negativity, which I think clearly all of our news networks are, I think it causes depression and concern where, really we should, remain more positive. I pretty much limit my news gathering to reading the Wall Street Journal and Investors Business Daily, which is now weekly. That's where I get most of my news. I do not listen to the radio at all, other than our radio show, and I very seldom turn the audio on the TV. So try and limit that. I'll just sum this up though with, if after all that you lose one night of sleep, I want you to pick up the phone and call me, and let's chat. And after that phone call, I'm going to send you our Riskalyze questionnaire. It's a great software package, and this will help me identify if we need to change your risk envelopes. And we've been using this with clients for about 3 months now. I think I've really started using it. It's a new technology, and it's much like a speed limit. And I'm just real quick, I want to explain how it works. So it's a blustery day here in Buffalo right now, snowing, roads are bad. If we were going to drive to Hamburg, one of the south towns, and I said, the roads are bad, what speed limit are you comfortable with me driving? And you said 45. Okay, great. We hop in the car, we start driving. I start going 45, and you say, no, not that fast. It's important that you feel comfortable doing that with your portfolio, right? Because the risk software and analysis is not a contract. You're not locked into that, right? And then we can adjust further from there. So if you do call me, we'll have a conversation. I'll shoot that out to you. You're going to shoot it back to me. We can adjust your portfolio accordingly. And, maybe now you want to throttle back a little bit. That's okay. Later you can get more aggressive. Most of you, I think, we should leave portfolios alone. But I totally understand the effect that behavior has on investors, and I want to be very sensitive to that. I hope this has really helped you, and I hope you have a wonderful day. Please, if you've got any questions, let us know or email me, and we're always happy to hear from you. Thanks a lot. Have a great day.